Very good evening to all esteemed partners, clients, friends who've joined us for the MP Code, Decoding of the Monetary Policy by Parijat Agarwal. Friends, a very warm welcome and thank you for taking time out to be here and to listen to what the expert has to say about all that's happened within the MPC today. So, without any further delay, I hand it over to my senior colleague, Parijat Agarwal, who heads our fixed income team at Union Mutual Fund, to take it forward. Over to you, Pari.
Thank you, Ati, and good evening to all of you. So today we had this outcome of the MPC. The RBI governor read out the MPC, outcome. So I'll share that PPT. Yeah. So it was a positive surprise for the market. So the MPC kept the repo rates unchanged at 6.5%. This was hiked by 25 basis last meeting. This meeting, the MPC kept the repo rate unchanged at 6.5%. The standing deposit facility remains at 6.25%, and marginal standing facility rate at bank rate remains at 6.75. So what it means is that it is a pause, after almost 11 months of a continuous rate hike of 250 basis points. This was the policy where there was no rate hike and it was a pause. However, to note here was that the governor emphasized that the pause was for this policy only. It should not be read that the further rate hikes would not be there. It could be there based on incoming data and depending upon the inflation numbers coming in. So, repo rate pause for this policy. And similarly, the MPC decided also to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. So the pause in the repo rate was unanimous. All the 6 members voted for a pause. In terms of the stance of focus on withdrawal of accommodation, 5 members voted for, 1 member said no. Now, what exactly it means that going forward, the policy rates and why it was that the MPC decided to pause for the policy rate. Now, the first and foremost was that, as if you read the statements, it comes out that the global uncertainty which has, seeped in after, we saw that the banking crisis happening in the developed economies, specifically in the United States, and then it happened in the Switzerland that Credit Suisse and then take over by the UBS. So now this has created a lot of uncertainty in the financial markets. The financial markets have become little jittery because of the extreme tightening by the central banks across the globe. With such kind of uncertain events happening, RBI thought the MPC thought it prudent to pause at this juncture and wait for the rate hikes which have been done for the last 11 months to actually filter through the system and effect comes through that. So that was one reason why the MPC decided to pause. The other important factor to note here is that why actually MPC thought of holding on to the policy rates despite the inflation remaining above the 4% mark, which is the MPC has a mandate to bring it down. So it is still closer to 6%, both the headline inflation as well as the core inflation. The domestic growth, that GDP numbers, which the MPC forecasted, is at 6.4% was for the February policy. In fact, when they announced today, it was an improvement over that number. It came at 6.5%. So that is where the MPC's projections are, that for the financial year 2024, the GDP is expected to grow at 6.5%. So one thing which has come out very clearly is that growth is resilient. Domestic demand has been very resilient. The urban demand remains robust as it has been reflected in healthy passenger vehicle sales, credit card spending. Rural demand has also registered healthy growth. So, and government's continued thrust on capital spending and infrastructure has supporting the investment activity, which is quite visible. The merchandise exports contracted in February and service exports, but continue to remain very, very strong. And capacity utilization in manufacturing is now above its long period average. So these are the factors which clearly tells you that growth is resilient. We still have a very healthy number going forward. So that's a very, very positive point to note. In terms of the credit deposit and the food weekly non-food credit and deposit growth rate, what we see is that the credit growth is at multi-year highs on back of spurt of activity as the economy heals, though it has moderated slightly as compared to previous few months. It may trend slightly downwards going forward. Now, the growth has picked up due to uptick in business activities post-COVID-19. Inflation induced higher working capital demand, capex done by government, higher personal loan demands, and increase in lending to NBFC segment has actually kept the credit uptick higher compared to the previous periods. If we move towards the inflation, which has been the point where the central banks have been hiking the rates across the globe to tame the inflation. Now, one factor which gave some comfort to the MPC was that for this financial year, it is expected that the inflation for the full year would be closer to 5.2%, and going forward, it should trend towards the 4% mark, which is their projection is. In fact, this number is tad better than what it was projected in February policy, which was at 5.3%. The projection shows that both the headline as well as your core inflation is expected to trend downwards towards the 4% mark. Now, the pickup in headline inflation has been due to rise in food prices. Core CPI has remained elevated across a range of goods and services. Now, moderation in global commodity prices have helped the input prices to come down. And that's actually, what we could see is that would start showing in the output prices also. And in fact, this is actually being visible across a set of, I would say commodities on, on the retail side also. If you can see that prices have started to trend downwards. And also the, in terms of the packaging, the grams have also started to move up. So that gives a very healthy sign that yes, inflation has started to trend downwards. Another point to note here is that household expectations of the inflation has also started to stabilize and trend downwards. So these factors, resilient growth and inflation trending downwards, has given MPC a lot of room for a pause and wait for the rate hike which they have already done to take effect and further help the inflationary trend to turn downwards. Now, if you look at what exactly it means, will the MPC hike the rates going forward, or what would happen that the MPC would hike the rates, or what would happen when the MPC would start reducing the rates? Now, first and foremost, the governor very categorically said that this pause is for only this policy. The further direction of the policy rates would depend upon incoming inflation and growth numbers. And inflation is still very high. For the last reading was at 6.4%. So last time when the repo rate started to the MPC started to cut the repo rates, the repo rate was at 6.5%, but the inflation was much, much lower. It was well below 4%. This time, however, the repo rate at 6.5%, but inflation is above the RBI's tolerance band of 6%, which is at 6.4%. So in the near term, what we believe is that unless the inflationary number or inflation number starts to trend towards the RBI's projected number, which is at 5.2, we could expect a pause. In fact, in the next policy, the expectation is that there could be still be a pause, and the MPC would wait, for a few months before taking a call whether to remain on a further extended pause or to hike the rates, depending upon how the inflation numbers are coming in. So that's one. The other factor is in terms of the growth. Yes, the growth numbers, some slowdown or, after the uptick was noticed, but it still remains resilient. It is still around 6.5%, which is a very healthy numbers. So in terms of the GDP growth, that is going to hold on. So if the inflation starts to trend downwards going forward, maybe, 6 months down the line, we could expect, some further softening in the policy rates. And that is when, maybe in the second half, we can expect that. The risks are actually from the global perspective, what we have seen recently, the geopolitical situations, like, the OPEC Plus deciding to, cut the supply of the oil. The oil moved up to $85 a barrel. So these kind of risks would remain, and that would keep, the job of the policymakers very, very tough. Another factor is that, in terms of the impact, what we had seen of the, Silicon Valley Bank collapse, whether it is contained or it is still something to be seen or noticed over a period of time. So that also has to play out, and that would impact the domestic rate setting also. One good factor for the domestic market or for our policy setting in terms of the rates is that the current account deficit is very, very manageable. It was around, for the first 3 quarters, was around 2.2%. It should remain around between 2.5%, which is very healthy and manageable. So in terms of the pressure on the INR, it is quite manageable and healthy number for the domestic economy. Now, in terms of the liquidity, the surplus liquidity which we had seen in the last so many months before the MPC started hiking the rates, it is still surplus, but it will remain well. It has come down substantially, and as per the RBI, they will continue to supply liquidity to the productive sectors of the economy. So in terms of liquidity, what we believe is that it will remain neutral to deficit kind of a scenario, but it would be the RBI would continue to support the markets in case there is a significant deficit in the liquidity. The one big factor to note going forward is that the government borrowing program. Again, the governor highlighted that they would ensure smooth completion of the borrowing program. If required, they will take appropriate actions to reduce the volatility in bond yields. On a YoY basis, money supply expanded by 9% as on April 5th. The forex reserves, which had come down to $525 billion in October, has come back again to $600 billion. So that's again a very good sign and healthy numbers to support the INR as well as the interest rates. India's external debt ratios are low by international standards. In the period ahead, while higher government expenditure and the anticipated return of forex inflows are likely to augment systemic liquidity, it would get modulated by the scheduled redemption of LTRO and TLTRO funds from February to April. So that's why I said that liquidity could remain on the your neutral to deficit kind of a scenario. The risk that we see for the bond markets is that geopolitical tensions and any untoward cases of further risk from the commodity market, the way it happened by just the way it happened by OPEC plus reducing the supply of the crude oil. Another point to note here is that in terms of coming at projections of the inflation, the MPC has taken for the full year $85 a barrel as the for calculating the inflation numbers. The risk here is that in case if it inches upwards towards a much higher number, that could be inflationary. So as of now, there are a lot of uncertainties emanating from the global arena, and this will remain uncertain. So suddenly, a lot of unknown things are there. So for which there is very, very difficult to project. But in the near term, yes, the rates are going to remain where they are. In fact, today the bond yields moved down by 7 to 8 basis points 10-year. It is expected to remain in this range going forward, and at least for the next 2 to 3 months, we believe that the range of the 10-year bond market bond would remain in this range. For the investors, what should they do? As I had been highlighted earlier, that the long bonds continue to offer a very, very attractive option for investors who are willing to take the volatility, but wait for more than a year and a half, because we believe that rates are going to trend downwards going forward, because a large part of rate hike has already been done, and there could be one rate hike or it can be two, but a substantial rate hike has already been done, and that's was one reason that why the MPC paused today. So for investors who are at the shorter end, liquid fund continues to provide you very attractive returns. The overnight rates are still around 6.25 to 6.5. So that's a very, very healthy return. As you move ahead on the yield curve, the short to medium term are very attractive. You still get around 7%. And as you move ahead, the long bonds, by nature of higher accrual plus M2M gains, are going to will offer you a much better return compared to the short-term products. Yes, volatility would be the day of the order. That will remain, because as I mentioned, there are a lot of unknowns are there, and it would depend on incoming data points. So that's in a nutshell about the MPC and how we see going forward.
Right. Thank you, Parijat. There are a couple of questions that have come up on the portal. Let me begin with that.
Yes,
sure. So the first question is, with the pause in rate hike, is it good news for long duration debt funds?
Yes, that's what I just said. The pause means that we are nearer to the rate hike cycle. There could be one or maybe two, depending on the incoming data, but a large part of rate hike has already happened. So going forward, your higher accrual, plus the M2M gains, which we have already seen in the last few days, and plus which are going to come, is definitely very, very attractive for the long bond investors. And in fact, if you ask, it is very attractive because your real interest rate is very, very healthy. So even if I take 6.5 as a policy rate, and if I take RBI's projection of inflation at 5.2, your real rate is in that healthy zone. So that itself gives a lot of comfort that going forward, rate hike could be very, very limited.
Right. Thank you. Second question is, if somebody has missed, I think it's coming in from the, from the point of people missing to enter debt mutual funds. Mm-hmm. So the question is this a right time to start entering and investing in debt mutual funds with the pause coming in?
I would say yes. Those who have missed or who have stayed out thinking that they will try to catch when actually starts to turn around the yield, they can still come in, because what we have seen is that only around 20 to 25 basis of rally, from 735 to 720 kind of a thing that we have seen. Lot still remains, but yes, you'll have to wait a little longer and accept the volatility in the markets. But you can still come in and make a very, very healthy returns.
Right. So there's also another question coming in, comparing, debt funds with corporate bonds and REITs at this point in time. Would you want to throw some light why still this, makes sense, Parijat?
Yes. See, despite all that taxation thing going away, the one thing is very clear that the M2M gains that which are going to come going forward, whether you are a 3-year maturity bucket or a 6 or a 10, depending on the duration that you are in, based on your risk profile. The pause today actually highlights that yes, we could be nearer to final pause going forward, or a pivot, I would say. Though this may not be the pivot, it could be further ahead. But then going forward, yes, there could be some rate cut happening, maybe 6 months or 9 months down the line. When that starts to happen, you have an accrual, which is you're getting it, say maybe at between 7 to 7.25. Plus, when the rates actually start to go down, you start getting M2M gains that, the bond prices go up because the yields are going down. So that gets added to your total return. So your total return, holding period return would be your accrual plus mark to market gains. So still very, very attractive, even if I'm paying that, in your that marginal rate of my tax based on that compared to the other products.
Absolutely. Thank you for that, Parijat. In fact, I'm just going to encourage participants to go on your question tab and keep putting in your questions. We've already received questions. So there is a question tab. You can type in your questions and it would come to us. The next question, Parijat, is from Mr. Gaurav Agarwal, asking if and when GST limit will increase. I think he's talking about the limit given to MFDs, in line with that.
I could get the question, Ati.
Yeah, the GST limit for every MFD is about 20 lakhs. Over and above 20 lakh of income, they are supposed to, file in, right? So will this limit be extended for more comfort coming in? So that's the question. Could I take this, please?
Yeah, please.
Yeah. So, Mr. Gaurav, I think it's slightly, challenging at this point in time, because if you've looked at the recent collection with the numbers that came in the beginning of April, we are at a, second highest ever GST, in this month, right? In March, basically 13% year-on-year growth with about 1.6 lakh crore, coming in. So considering that there has been an impact on inflation on this, considering the way we are as an economy right now, it looks slightly difficult for this personal limit, to kind of, come down to give relief to MFDs at this point in time is what, we think, right? All right. Parija, the next question is from Mr. Narayanan Sri Gopal. He is asking, how would the journey of debt funds be after this RBI policy meet?
After this RBI policy, as I mentioned, this has been a pause, but this could be one-off, or it can be a pivot. We do not know. It would depend upon the incoming data. But yes, as I mentioned, it is almost a bit towards the last few policy where we could see the rate hike happening, maybe going forward. But going forward, as I mentioned, the inflation has already started to trend downwards, which the data is showing. And not only in India, but also in the US markets, which we have seen. The lot of data points are actually showing in US also that the employment and wages are getting impacted because of the rate hikes. So obviously that is a concern that the further rate hikes would move towards a recession kind of a scenario and would impact growth in the advanced economies. So obviously, when this happens, the central banks stop the rate hike cycle. That would happen in India also. And this is one of the cues of the pause, that it means that more or less we are done. And going forward, we could remain on extended pause. And then the entire impact of 250 basis point rate hike would start to seep in. And then we could see that inflation trending downwards to 4%. When that starts to show, or that trend line starts to begin, we could expect that RBI to start, softening and cutting rates. So, your, yield should start to fall much more than what they are today. So, if for investors, it is advisable to remain invested despite having volatility in the markets.
Right. Thank you, Parijat. Couple of questions coming in from Mr. Mata Prasad Pandey. The first one from him. As there is enough clarity, do you think the 10-year yield will remain stable, or we may see some pressure there due to any demand-supply mismatch?
See, right now, as I speak to, I thought I was around 7.20. Now, we need to see very, credible numbers on inflation for it to move towards 7% mark. But yes, it would remain in this zone because we have a heavy supply of government borrowing, this financial year. So it would remain in this region, and maybe 10 basis points we can see up and down depending upon the demand supply mismatches.
Right. The second question from him again. What's your view on this removal? I think that's been addressed, of the LTCG removal, and the impact on corporate bond yields is what he's asking. Would would they really be impacted meaningfully? I think that has already been taken up, sir. And just to sum up, Parijat mentioned that the MTM gains can and may be quite significant as we move along. The third question from him, Parijat, is what risk to inflation do you see specifically due to supply cut by OPEC? Can it be a threat to our inflation, biggest enemy of the hour across the globe? Is what he is foreseeing. Yeah.
You see, OPEC Plus has already, done that, cut in the production. So fortunately, we have been buying, oil at a, a discounted price from the Russian. So that should help us, tide over, whatever the crude price have. We have seen that $5 to $8, uptick, which has moved to 85. But yes, if it continues to move towards, for hypothetically say, that towards the $100 a barrel, yes, that could be a risk. But as of now, the probability is less because, the global growth is slowing down. And that's one reason that, OPEC Plus wanted to keep that around $80 a barrel. So that's why they must have reduced or said that they want to reduce the supply of the crude.
Right. Thank you. Question from Mr. Matthew Kurian. What will be the impact on 81 bonds?
See, 81 bonds, actually, there has been a lot of regulations much before, the entire episode happened. So going forward, anyway, the demand from the mutual funds are very, very limited because of a lot of regulations and, the risk associated with that. But the investors who can stomach volatility and, who are institutional investors like banks or the insurance companies, the demand from them would remain because it is a very long bonds and it suits their asset liabilities, to bridge that, any gap if it is there.
Right. There's a question coming in from Mr. Sushil Ramprakash Sahani. As per the new tax rule for debt funds in the current situation, is it better to keep in liquid funds or better to move to arbitrage as a category?
To keep it in liquid funds or move. See, liquid funds to anyway was paying around your, the marginal rate of tax based on your, the income bracket. So there's no difference, it is only for the, the long bonds which were, were holding period for 3 years. Because liquid and arbitrage, anyway, liquid we were paying around, say, for example, 30%. because the holding in liquid is for not more than a month maximum. Generally, it is there, and similarly in the arbitrage. So based on I would say that the requirement of the investor, I would say that to choose between liquid and arbitrage. But yes, the liquid would give you slightly better returns, irrespective of the tax, because of, as I mentioned, the liquidity will remain from neutral to deficit.
Right. There's a follow-on question coming in. Would the credit scenario improve considering the current scenario in the debt markets?
In fact, it had already started to improve the credit scenario. Reason being, the balance sheets of the most of the corporates has become healthy. They have deleveraged, and also the lending practices by the banks and financial institutions have become much more robust. So the credit uptick is also showing that. So the entire credit scenario has improved, and it is expected to improve further going down the line.
All right, Pari. I don't see any further questions. I think we can wait for a minute maybe to see, because questions are coming in as we are talking about it.
Yeah, we'll wait.
I think no further questions from any of the participants. I take this opportunity on behalf of the entire team at Union Mutual Fund to thank everyone who's logged in. So on behalf of the fixed income team and on behalf of all of us, a big thank you, and do stay connected with us in our social media pages, and we would be happy to connect at all points in time. Thank you so much.
Stay invested.
Thank
you.